Welcome to The Explainer. Listen, today we're tearing down the actual blueprint for true wealth creation in the stock market. We're going to walk through the complete investor's journey. So we're talking about how to build a massive portfolio from the absolute ground up, how to strategically and honestly ruthlessly take profits when you hit a grand slam, and finally, how to spot those rare multi-bagger opportunities before the rest of the market even wakes up to them. If you've ever wondered how the pros scale their accounts without letting emotion hijack their returns, you are in the exact right place. Okay, let's dive into our roadmap for today. We've got 3 masterclasses lined up. First, the art of scaling your portfolio. Second, a deep dive case study into a massive exit plan using AMD stock. And third, we'll look at the explosive long-term potential of LF Beauty.
All right, part 1, the art of scaling.
So building a portfolio isn't just about picking the right stocks, right? It's really about adopting a very specific foundational mindset. And the first myth we absolutely have to shatter today is this idea that you can just force your portfolio to grow faster through sheer willpower. To really get this, we need to talk about the concept of sprinting in a relaxed manner. Think about Olympic sprinters for a second. When they hit their absolute top speeds, their faces are totally relaxed, their shoulders are down, their hands are open. It's a total paradox. I mean, they are pushing as hard as humanly possible, but remaining completely relaxed so they don't tense up and actually slow themselves down. Or, if you're a golfer, think about what happens when you step up to the tee and tell yourself you're going to just crush the ball with all your might. You tense up, you try to force it, and the shot goes completely off the rails. Well, the stock market works the exact same way. If you're constantly obsessing over short-term metrics and trying to force your way to that next financial milestone, you're going to make emotional errors that end up slowing down your wealth accumulation.
And that brings us to a really critical strategy for that relaxed, sustainable growth. It's called GVD, which stands for growth, value, and dividends. Look, we've all seen one stock go on a massive run and thought, man, I should have just dumped all my money into that one company. But that is an incredibly dangerous mindset. If you treat the market like a roulette wheel, just putting everything on black and feeling like an absolute genius when it hits, that is a guaranteed way to lose your capital when red inevitably comes up. Instead, GVD is about building a well-rounded portfolio of, say, 7 to 20 stocks. It's that exact diversification that lets you survive the inevitable market storms, corrections, and crashes without getting totally wiped out.
So this relaxed mindset feeds perfectly into our 5 golden rules for portfolio growth. Number 1, you've got to generate more income than expenses. The wider that gap, the more capital you have to deploy and compound over time. Number 2, diversify, using that GVD strategy we just talked about. Number 3, and this is huge, reinvest all your dividends and profits. Don't take your dividend payouts and blow them on a fancy dinner. Leave that capital in the portfolio to relentlessly compound unless you're, buying a house or actually retiring. Number 4, stay completely away from margin, options, and leveraged ETFs. Honestly, those require a level of emotionless discipline and time commitment that 99% of investors just don't have. And finally, number 5, make every single buy and sell decision based entirely on the numbers, not on market hype or how much a stock has already gone up or down. Let's look at exactly what buying and selling based on the numbers actually looks like in the real world, and we'll use American Express as our example. If you run the projections for 2030, assuming a solid 8% revenue growth and 12% net income growth, you can establish some really clear mathematical boundaries. So at $346, it's a great buy because the compound annual growth rate, the CAGR, is well into the double digits. Down at $246, the return profile is so spectacular you'd literally want to load the boat. But look at what happens when the price jumps. If American Express hits $546 today, mathematically it's no longer a buy because your future returns shrink drastically. And if it hits $646 today, the math absolutely demands that you sell because the upside for the coming years is essentially zero. Doing it this way takes the emotion out of it entirely.
Okay, let's move on to part 2, the AMD exit plan.
Because, look, it's one thing to pick a winning stock. It's an entirely different beast to actually execute a disciplined exit strategy when you're sitting on massive gains and the whole market is screaming at you to hold forever. When you're up incredibly high on a position, the very first question you have to ask yourself is, do I want out completely or do I want to hold a core position for the super long term? In this specific case study for AMD, we're looking at a hybrid approach. Out of a total holding of 2,555 shares, the strategy here is to lock away 1,000 shares for the super long term. That means holding them through multiple future semiconductor cycles. And that leaves exactly 1,555 shares that need to be tactically, strategically sold based strictly on valuation math.
Now, what's really fascinating about this specific base case math driving the exit is the projections themselves. They have AMD doing 35% average annual revenue growth and 50% net income growth over the next few years. That brings 2030 revenue to around $165 billion. Ultimately, this gives us a 2030 price target roughly between $879 and $1,054. But here's the absolutely critical thesis behind these numbers. There is a high probability of a major industry slowdown right around 2029 or 2030. Think about it. The semiconductor industry is seeing an absolute frenzy of chip ordering right now. Eventually, all that over-ordering leads to a hangover. And because we're projecting that cyclical come down, it anchors our target multiple to a much more conservative 25 to 30 times earnings. That effectively caps our base case price target at around $1,000. So with that baseline established, we can build a purely mechanical set of steps for taking profits on those remaining 1,555 shares. Step 1. Wait for AMD to cross $625. Step 2. The second it crosses that threshold, immediately sell the first 200 shares. Step 3. For every $25 to $50 the stock increases above that $625 mark, sell another 200 shares until all 1,555 are gone. Now, you might be wondering, could market hype and momentum drive AMD to $1,000 way faster than our 2030 timeline? Absolutely, for sure. Wall Street loves to extrapolate short-term massive growth rates into eternity, which creates these wild hype cycles. But remember, we aren't trading on hype. We're methodically scaling out as the stock gets closer and closer to its true mathematical ceiling.
And I've got to say, executing a plan like this requires what we call an abundance mentality. When you start sharings, the stock might just keep going up. You might watch it climb and think, oh man, I left money on the table. You have to train your brain to be thankful for the massive profits you secured. Have absolutely no regrets. Because the reality of the stock market is that there is always another massive opportunity right around the corner. I mean, before Tesla went on its huge run, there were other giants. After Tesla, there was Palantir. After Palantir, AMD and Micron. If you exit a position because the math literally tells you the future ROI is shrinking, you've done your job perfectly.
And that transitions us nicely into part 3, e.l.f. Beauty's long-term potential.
So since we just took profits, it's time to cast our lines back into the water and find that next big fish. Let's look at the cosmetics landscape. e.l.f. Beauty is currently sitting at a market cap of roughly $4.5 billion. Now compare that to the established titans in the space. You've got Estee Lauder sitting around $30 billion, and L'Oreal is an absolute behemoth at $231 billion. e.l.f. is just a baby compared to these giants, but that right there is exactly why the runway for growth is so staggering. The underlying thesis is that e.l.f. has both the momentum and the operational playbook to become a top 5 global cosmetics company over the next decade.
When we look at the projections for 2030, the math gets incredibly compelling. The base case puts e.l.f. at $3.2 billion in revenue and just over $400 million in net income by 2030. If you apply a perfectly reasonable 30 to 35 price to earnings multiple to that, you easily have a stock pushing past $200 in the medium term. But the real secret sauce driving these numbers, it's e.l.f.'s aggressive and highly successful acquisition strategy. They aren't just relying on their core brand to do all the heavy lifting. They're out there buying up rapidly growing brands with massive total addressable markets. Brands like Naturium, and they are fully willing to pay a premium to acquire that aggressive growth. As they scale up, their hundreds of millions in net income will just serve as dry powder to buy the next great brand. They're basically building a powerhouse portfolio of billion-dollar beauty lines all under one roof.
And that compounding acquisition loop is exactly why we're talking about a massive $500 milestone. Looking out over the next 10 years, driven by CEO Tarang Amin's leadership and overall strategic vision, e.l.f. genuinely has the underlying fundamental strength to march toward a $500 stock price. Listen, when a company is this efficient at acquiring and scaling complementary, high-growth brands within a massive industry, a market cap in the tens of billions isn't just some pipe dream. It's the literal mathematical trajectory they're currently on.
Wow. So we've covered a tremendous amount of ground today in this explainer. From the disciplined psychology of scaling a portfolio to the totally emotionless, step-by-step execution of taking profits on AMD, and finally, uncovering massive future scale with e.l.f. Beauty. But now, it's time to turn the mirror back on your own portfolio. If you are sitting on a massive winner right now, I want you to ask yourself this one critical question. What is your math-based exit plan? Not your emotional hope, not your knee-jerk reaction to headline, but your concrete numbers-driven strategy. Because as we've seen today, that discipline is exactly what separates the gamblers from the generational wealth builders. Thank you so much for joining me today, and I'll catch you on the next one.